Welcome to the Dental Business Guide podcast. From money to marketing to management, this podcast will help you run a better dental business.
Okay, let's unpack this. We are diving deep into one of the most dynamic sectors in healthcare right now, the Dental Service Organization, or DSO market. But we're not just looking at growth. We're focused on this really intense, time-sensitive race to build maximum enterprise value ahead of a critical deadline, the 2030 consolidation window.
That's the entire game right now. Our sources today are, well, they're synthesized from what the industry is calling the DSO Playbook, Exit 2030.
Okay.
Think of it as the ultimate operating manual, sort of a due diligence cheat sheet for dental groups aiming to scale properly and, exit with the highest possible multiple.
And crucially, this guide isn't just for the people running the clinics. It's essential reading for investors, too. They need to know what a good target even looks like.
Exactly.
So our mission today is to cut through the noise and give you the absolute shortcut. We need to dissect the core levers that drive real enterprise value.
The difference between a 4x multiple and a 10x multiple.
Yes. We're moving beyond just counting chairs.
That's the old way. True exit readiness depends on focusing on four non-negotiable pillars: predictable EBITDA, ironclad operational consistency, real leadership depth, and increasingly provable clinical governance.
Before we jump in, you have to appreciate the scale of this opportunity. This pressure cooker is being built by just an incredible amount of capital deployment.
The numbers are staggering.
The global DSO market is projected to grow at a compound annual growth rate of, get this, 17.67% between 2025 and 2033. It's estimated to hit USD $429.4 billion by 2030.
That kind of growth trajectory, it just attracts serious players. And to put a fine point on it, our sources confirm that 130 private equity firms backed DSOs between 2023 and 2024, just in that one window.
Wow. So if you're an operator, that means your potential buyer pool is enormous,
But your margin for error in execution is razor thin. This is a competition for capital, plain and simple.
Let's jump into segment one then. The exit mindset and financial stakes. The sources refer to the period from 2025 to 2030 as the golden window for DSO growth and exits. Why this specific 5-year period? What makes it so crucial?
It's really a convergence of a few key macroeconomic and demographic factors.
Okay.
First, you have this huge cohort of retiring practice owners. They're finally ready to sell, to monetize decades of hard work.
Right, the supply side.
Exactly. Second, demand for dental care remains remarkably stable, which supports predictable revenue models. And third, despite some recent volatility, lending conditions for well-organized groups are still favorable.
Meaning buyers can get the debt they need to finance these premium acquisitions.
They can. So the supply of sellers is up, demand is stable, and the capital is there.
That sets the stage. But here's where it gets really interesting for me. The valuation criteria have fundamentally changed. It used to be a vanity metric, right? How many clinics you own.
Oh, absolutely.
Now, the sources stress it's almost entirely about EBITDA quality and operational discipline.
That is the key shift. Buyers aren't purchasing your historical revenue, they're purchasing future predictable cash flow. The strongest DSOs, they don't just expand, they plan from the exit backwards.
What does that mean? Plan from the exit backwards.
It means every operational decision they make is designed around improving EBITDA quality, proving cash conversion reliability, and demonstrating that they have mature governance. A buyer will pay a premium for a business they can just seamlessly plug into their own system.
And what does that shift mean practically for valuation? We know fragmented single-location practices don't command much, but the sources cite a valuation sweet spot.
Yes. Practices or small groups with EBITDA in the $1 to $5 million range tend to trade at the highest multiples.
$1 to $5 million. Why is that range so critical?
Because they're large enough to demonstrate proven, repeatable processes, but they're still small enough to be attractive to a huge universe of buyers. From smaller regional DSOs to massive financial institutions looking for a platform acquisition.
And the reward for getting that quality right is enormous. Multi-location DSOs that demonstrate this consistency routinely achieve, 9 to 12x EBITDA multiples?
That's right, 9 to 12 times. And for the listener, that 10x multiple, it signals trust. Which translates to de-risked future cash flows. When a buyer pays 10x, they're essentially saying, I am so confident in your predictable systems, your clinical consistency, your management depth, that I believe I'll recoup my investment in 10 years or less without having to overhaul the entire operation.
So a low multiple is just a reflection of risk.
It's the buyer saying, I'm assuming I'll have to clean up the mess.
And part of that cleanup starts with financial hygiene. If you're chasing that premium multiple, what are the absolute non-negotiables on an investor's checklist?
It all boils down to rigor. Investors demand a standardized chart of accounts across all sites. No exceptions.
Apples to apples comparison.
And crucially, they expect monthly management accounts to be closed and delivered within 10 working days.
10 days. That's aggressive for a complex multi-site operation. What happens if an operator is still closing their books in, say, 45 or 60 days?
That delay signals a fundamental lack of control. It just kills a multiple immediately because it introduces uncertainty.
Okay.
Furthermore, consistent tracking of cash conversion, how quickly reported profit turns into actual cash in the bank, that is non-negotiable. If you have strong clinical performance but weak financial hygiene, your valuation drops. Simple as that. The buyer has to bake in the cost of fixing your back office.
That makes the link between discipline and dollars crystal clear. Now let's pivot to segment 2, which I think challenges a common assumption. We often think of clinical quality as a soft metric, something nice to have. But the Playbook treats it as a core financial risk indicator, the predictor of long-term sustainability.
That's the deep insight here. Clinical quality isn't just about patient happiness, it's about minimizing variability.
Variability.
Investors want DSOs that demonstrate lower variability. That means lower patient churn, fewer legal issues, and a more stable earnings profile you can rely on year after year.
So what specific clinical drivers are investors now scrutinizing?
They're looking for evidence of operational standardization on the clinical side. We're talking consistent treatment protocols across all sites.
So if filling in Clinic A is the same process as in Clinic B.
Precisely. They monitor low complaint rates, strong patient retention, things that prove the clinical model actually works.
And I assume reliable recall systems and preventative care metrics are essential because that ensures that predictable patient flow you mentioned earlier. That's the engine for recurring revenue, isn't it?
Exactly. Preventative care is the baseline of predictable income. To show how serious this is, we have a great case study nugget, the My Dentist transaction.
Right.
This deal, it basically reset the industry benchmark by showing that strong clinical systems and governance, which reduces operational risk influence valuation as much as commercial growth.
And the numbers back that up. My Dentist's adjusted EBITDA rose from, what, $73.2 million to $83.8 million in FY 2024. How did that improvement in clinical governance translate to a nearly $10 million jump in profit?
By controlling quality, they reduced expensive rework. They stabilized their team because clinicians had clear expectations, and they improved retention. That governance structure became a competitive advantage. It lowered the true cost of delivery.
This also brings us to specialization as a growth engine. General dentistry provides stability, but the sources are clear. General dentistry alone won't unlock those premium multiples.
No, you have to diversify your revenue. The Playbook highlights high-value specialties like orthodontics, implants, facial aesthetics as the key drivers of stronger revenue per patient.
And those are typically high margin and less dependent on insurance.
Exactly. And the demand for specialization is driving the whole market. We see the global DSO market CAGR for specialty services projected at 11.5% from 2025 to 2034.
So operators who can consistently deliver high-end specialty services across multiple locations are positioned for the highest multiples.
But that growth has to be protected by compliance. And this is where weak governance gets penalized. If we look at UK data, the General Dental Council received 82 whistleblower disclosures in 2022-2023.
82. And what happened?
60 of them resulted in regulatory action. For a buyer, those 60 actions represent massive potential financial liability, legal costs, and reputational damage.
So strong governance is less about ticking a box.
And more about providing verifiable proof that the organization has reduced systemic regulatory risk. It's a powerful valuation lever.
Let's move naturally from clinical standardization to operational standardization in segment 3 and the role of technology. The sources are clear about the integration challenge.
Oh, it's huge.
Most DSOs struggle to scale because they're still operating as fragmented units.
It's the sheer weight of what they're acquiring. The industry remains so fragmented. More than 75% of dental practices are still single-location practices. So when a DSO buys one, they inherit disparate systems, unique software, and often a highly customized local culture. The integration burden is just enormous.
And that burden leads directly to what the sources call the cultural bottleneck. If you can't integrate the culture, the acquisition fails financially.
Precisely. Lack of cultural alignment is a major deal breaker in M&A because it impacts the patient experience immediately.
How so?
Well, if the DSO changes the familiar front office staff or introduces a confusing new scheduling system, the patient notices. And that inconsistent experience can lead to the loss of more than 25% of patient volume within 6 months of an acquisition.
25%. So you pay 10x EBITDA for a business that immediately starts bleeding revenue.
You got it. It's a disaster.
That puts an incredible amount of pressure on standardizing those front office operations. The next stage of growth, then, it has to be digital.
Yeah.
AI, automation, data. That has to become the engine.
Absolutely. We've seen AI evolve so quickly. It started with simple diagnostic tools like basic radiograph interpretation. Now it's moving into fully integrated decision support systems that apply to operations and revenue protection.
Let's look at the measurable ROI. We have some specific AI nuggets here on how automation directly protects EBITDA.
The benefits are substantial and immediate. Studies show that AI scheduling tools, which monitor cancellations and automatically fill open slots via patient texts, they reduce no-show rates by 15 to 30%.
15 to 30. That's found money.
It is. Furthermore, practices using AI-driven communication tools, which ensure timely follow-ups and personalized engagement, they improve patient retention by about 20%. These tools are protecting revenue that used to just walk out the door.
Those numbers directly translate to maximizing chair utilization, which is the heart of dental profitability. But with digital maturity comes digital risk. We have to counterbalance the benefits with security concerns.
A critical point. The sources warn that over 30% of dental practices have experienced a high PAR-related breach in the last 3 years.
30%.
That statistic just underscores the absolute necessity of robust data security and ethics. If you build this efficient, integrated digital machine, you are also building a single point of failure that must be defended at all costs.
So digital maturity isn't just about efficiency, it's a defensive measure.
Exactly. It standardizes workflows, protects EBITDA by reducing errors, and provides the real-time performance tracking that allows leadership to intervene early across all clinics before problems metastasize.
Let's transition to our last segment. Leadership, continuity, and the global scale solution. Even with the best systems and the cleanest financials, you still have the people problem.
Always.
A survey cited by the sources found that 69% of respondents cited weak leadership as a top contributor to a negative culture.
This is a function of the classic structural flaw in healthcare. It creates the what we call the investor-clinician divide.
Explain that.
Well, investors want scalable processes and maximum returns. Clinicians, rightly so, they prioritize patient care and professional autonomy. This tension is very real.
And the problem is reinforced by education gaps. Something like 42% of surveyed dentists reported receiving little to no business training.
Right. So you have these great clinical leaders who are suddenly asked to manage complex financials and HR issues for multiple locations, and they often just aren't equipped.
So what's the solution?
The Playbook focuses on bridging that divide by implementing shared metrics, clear communication, and professional management training. You have to align the goals. The clinician sees a healthy patient. The investor sees a predictable, recurring revenue stream from that patient. When both are valued and measured, the tension decreases.
And this leads directly to succession risk. Only 21% of healthcare institutions have formal succession plans.
A tiny number.
This reliance on the founder or a handful of senior leaders creates massive concentration risk. A buyer looking at a 9-figure valuation can't afford to see 70% of the value walk out the door when the founder retires.
No, distributed leadership is mandatory for that premium multiple. If the value rests on one person, the buyer will heavily discount the deal. And this brings us to a strategic tool DSOs are leveraging for both scalability and succession. The Global Capability Center, or GCC.
A Global Capability Center. For listeners who aren't familiar with the concept, how does a GCC function within a DSO structure? And why is it a tool for succession planning?
A GCC is essentially an internal shared service center, often located in a lower-cost geography. Its function is to systematically shift dependence away from local high-cost individuals.
Like the founders or senior U.S. finance leaders.
Exactly. And move it to a standardized, scalable system for repeatable functions, like finance, compliance reporting, HR, and tech support.
So this isn't just basic outsourcing. It's about institutionalizing the back office functions so that the founder or the local clinic manager is free to focus on clinical excellence and patient-facing growth.
Precisely. By moving that back office transactional work into a shared service, PwC data shows organizations typically realize operating cost savings between 10 to 30%. But the real value is the stability. A GCC provides that durable, permanent operational backbone that stabilizes performance during a leadership transition. It creates a powerful second line of defense for your EBITDA.
And this trend is accelerating globally, which gives it immediate credibility.
Correct. India already houses over 55 healthcare and life sciences companies operating more than 95 GCCs. The structure demonstrates you have a machine that can run, regardless of who is sitting in the CEO chair.
Protecting the value right through that 2030 exit window. Okay, so what does this all mean for the listener, the operator or investor looking at that 2030 finish line?
It's clear that success requires deliberate, integrated execution of all these strategies. Today, you can't wait.
Based on everything we've explored, what are the main takeaways?
I'd say there are 5 main takeaways that demand action right now.
Okay, let's hear them. Number 1.
Standardize operations across all clinics. You must reduce variability and increase predictability. That's the definition of EBITDA quality, and it's what premium buyers pay for.
Number 2. Build strong leadership and succession plans.
Right. Reduce transition risk by formalizing management training and building depth that operates independently of the founding team.
Third, diversify revenue and protect cash flow.
Yeah, reduce volatility by expanding specialty services and using technology to ensure that predictable recurring patient revenue.
Fourth, maintain clinical quality and compliance.
You have to safeguard your EBITDA by demonstrating robust governance, minimizing clinical variability, and ensuring consistent outcomes across all sites.
And finally, number 5, prepare for exit strategically.
Yes. This means actively building a clean, verifiable financial story, ensuring you're ready for due diligence, and communicating a compelling systemic growth narrative to maximize valuation well ahead of 2030.
If you take one final thought from this deep dive, let it be this. The sources make it clear that 2030 is less a distant timeline and more a forced evolutionary marker.
You cannot wait to implement these systems. Every operational or leadership decision you make today either increases your exit multiple or puts it directly at risk.
So the question for you is, which critical operational or leadership system are you standardizing today to ensure your business survives and defines the next decade of consolidation rather than simply being absorbed by it? Thank you for diving deep with us.
Thanks for listening in to the Dental Business Guide podcast. We welcome your feedback, and if you're enjoying it, please let your friends know too. Until the next time on the Dental Business Guide podcast.